Welcome to our third quarterly update of 2019. I'm going to start with some interesting news that occurred during the quarter before looking into returns for the last 3 and then 12 months. Unsurprisingly, the news that has already dominated 2019 continued to do so during the September quarter. The US-China trade war, with the US president making a series of pronouncements, resulted in positive and negative lurches in sentiment throughout the quarter. However, if he's to be believed, the Chinese are coming back to the negotiating table in November. Let's watch this space. That other unconventional leader, Boris Johnson, stared down his own parliament, didn't like what he saw, and so attempted to suspend parliament through the process of prorogation. The Queen said yes, the court said no. So in the end, parliament didn't get suspended. But he did, at least not during the quarter, but slightly afterward, get to a deal. Whether or not it gets through as parliament remains to be seen. And in Hong Kong, protesters were trying to have their say about Hong Kong staying Hong Kong and pushing China out. The Chinese didn't like that very much. So not a great 3 months of news, at least for markets, you would assume. So, how has the market priced that news? Well, broadly, positively. Aussie shares were up 5.6%, the leader for this quarter. Now, New Zealand were a very credible 4.4% in second. Okay, joint second. What about international developed markets? They did really well, at least in an unhedged position. The New Zealand dollar didn't do well against its relative trading partners, so unhedged shares did really well. In fact, everything was positive during the quarter. That's unusual, but I've now said that 3 quarters in a row. We've had 3 consecutive quarters where every asset class has delivered a positive return. Well, that's a bit surprising, given the somewhat uninspiring news we just discussed. This slide shows the growth of $1 over 3 months in various different asset classes. Now, notwithstanding that news, as I mentioned earlier, everything was up. So over the course of 3 months, a diversified mix of 50% in shares and property and 50% in cash and fixed interest would have gone up to about $1.03.50, or a return of 3.5%. That's pretty good. I've said before that there's not necessarily a lot of information in 3 months. What about the last 12 months? This time period includes the problematic December 2018 quarter. Now that quarter, which was one of the worst in the last 10 years, saw $1 invested in international small companies almost touch 80 cents as at the end of December 2018. Not very much fun. Now by the end of September, that dollar was all back, plus a little bit more besides, but still not a very pleasant ride. But we would never suggest you invest all of your money in international small companies or in any one asset class. We would always suggest that you should take a diversified approach. So what would a 50-50 mix of shares and property and cash and fixed interest have delivered over that 12-month time period? Well, it would have turned to just over $1.06. Or stated another way, that would have had a return of about 6.6%. That's actually a pretty good year. It's easy to feel anxious about investing these days. Our screens are full of prognosticators and those who claim foresight about share prices going down because of trade wars or Brexit or Hong Kong protests. But diversified investors, those who accept that actually all that information is already in the prices, typically perform well, despite all the media's attempts to make us worry about the contra. I look forward to presenting to you again sometime in early 2020.